What's going on, everyone? We're diving into some multiple choice questions on valuation methods and models. Let's begin. The difference between the market return and risk-free rate is known as what? My best approach here is, where do you see market return and risk-free rate? I see them in the CAPM formula. This is why it's super important to have your formulas memorized. So not only if they say what's the CAPM formula, you can write it out, but also if they say some points that are in your CAPM formula, you know it's CAPM and you can write out the whole formula. So CAPM formula is risk-free rate, say it with me, risk-free rate plus the beta times market rate minus risk-free rate. Gosh, I guess I'm losing it today, aren't I? All right, so from there, market rate and risk-free rate, the difference between those. And why did that come to my mind? Well, because the difference between them is in the CAPM formula. Another way of saying this, I've mentioned this before, in here, this is also known as the market risk premium. What is that? The risk-free rate is treasury bonds, right? Risk-free rate, T-bonds. This is the safest investment there is. The only way that you will not get your money back with a treasury bond is if the U.S. government completely collapses. And like I remember one of my professors saying, if the U.S. government collapses, we've got bigger problems than your treasury bonds not paying out. So usually this is a pretty low rate because it's very safe, right? You're not going to lose your money. It's 2%. So let's say it's 2%. The market rate, I'll call that the S&P 500. And if you're not familiar with that, that is the overall market, generally accepted to be the overall stock market. It's the 500 largest companies in the United States. And again, generally used as a metric for the overall market. So if the overall market is making 12% a year, it's pretty good, right? This is you risking your money because in theory, these companies are companies that can go out of business and the US government can't go out of business. Now, I mean, sure, Apple, Microsoft, pretty solid, safe companies, right? With those, if those went out of business, we probably also have similar problems, but hey, that's a discussion for another day. Now, the difference between those is what we see is we see MR minus risk-free rate. That difference there is 10% in my made-up numbers. That 10% is essentially the market risk premium. That's the premium you're getting over the risk-free rate, over the safe rate. You're risking your money to get an extra 10%. For example, if the S&P was only making 2% a year, there's no reason you would put your money into the S&P because I'd rather put my money in treasury bonds, which are, on paper much safer, and you will be guaranteed 2%. Here, you're not guaranteed 2% at all. So that we're back to 12%. This is the market risk premium. This is the premium, right? Premium is good. This is the premium you get for investing your money and risking it. Premium you get for risking your money in the market. That's what this is, and I was beating that to death for good reason. I want you to definitely understand this. And what does that equate to here? Well, that's the equity risk premium, not debt, and it's not a discount. It's you getting excess over it. So it's never going to be lower, right? It would never be lower than the risk-free rate because that's just not how it works. You're gonna get more money for your risk, and these companies are innovating. You're gonna get more return with these companies than the U.S. government. And final answer is equity risk premium. So yeah, it would never be a discount, and it's not debt because it's the market. And CAPM formula is used to calculate the cost of equity. So another reason why it's equity and not debt. Awesome. Which of the following metrics equates the present value of a project's expected cash inflows to the present value of the project's expected costs? This is quite a fancy way of saying present value of a project's inflows, so inflows compared to outflows. We see this a lot, and I'm going to write out a couple formulas. When you see inflows and outflows, well, rate of return, let's think of you. Let's think of your stocks. Rate of return is, let's say you buy a stock at $12 and now it's $15. Another formula we know is our percentage change formula, which is the rate of return. It's new minus the old, so the new amount is 15 minus the old of 12 divided by the old. Divided by $12. That's the old. Great, wonderful. So that is going to get us our rate of return of 25%. Good for you. Do that math there. That's 25%. A rate of return generally also is inflows divided by outflows. And I'm running through these formulas here because they all come together. You definitely need to know all of these. And they help you understand, right? They come together and help you understand, like, how can you solve this in many different ways, depending on the information provided. Let's say I get a dividend, right? Forget your stock going up in value. I just want the dividend. So let's say I get $4 in dividend throughout the year. I paid $10 for this stock. So good for me. 4 divided by 10, that gives you a rate of return of 40%. So generally speaking, a rate of return formula is inflows divided by outflows. And net present value, a good formula for that is inflows minus outflows. Hence why you don't want a project with a negative net present value, because if you're going to lose money, if our outflows are greater than our inflows, well, like, duh, why would you accept that project? Awesome. Just talking about that a little bit more there. And let's finally address the question. I just want to make sure you're familiar with all this before we get into it. So economic value added, to be honest, I'm just going to cross this one out. That's not really involved with anything here. It's not relevant. Just really not worth your time to really dive into. Return on assets. This is another formula we should know, right? That's you see that just like in our practice overall, you see a formula and I would write it out, because when you write out your return on assets formula, you get, say, return on assets. And again, a side note, anytime you see return on something, so return on assets, return on equity, return on means you'll have net income in the numerator. If you weren't familiar with that, now you are. In this case, it's net income divided by assets. And yeah, that doesn't really have anything to do with the inflows and outflows. So sorry, return on assets, we're going to cross you off and ignore you. But it was good practice, good to recollect there. Again, return on means net income is going to be in the numerator. That leaves net present value and internal rate of return. Great. Well, net present value, we essentially are looking for a rate. That's kind of the key differentiator here. The internal rate of return is a metric that's used in financial analysis to estimate the profitability of potential investments. The internal rate of return, it's also known as a discount rate that makes the net present value equal 0 in a discounted cash flow analysis. Whereas the net present value, this is used to calculate the value today of future streams of payments. If the net present value is positive, like I was saying, it means that you want to accept it, and it means that the discounted present value of all future cash flows related to the project will be positive, and therefore it's an attractive project. You discount these, right? Because if you're getting inflows 3 years from now, let's say I'm getting an inflow of $1,000 3 years from now, that's not really worth $1,000 to me, because, okay, yes, someone will hand you $1,000, but in that 3-year period, we've had inflation, we have time value of money, meaning I could have used this money to pay off bills. We've also had opportunity costs of what we can invest it in. There's a bunch of factors, and that's why when we see our discounting and our present value factors, those numbers, those rates are determined by actuaries, very mathematically based people that take into account a lot of economic and macroeconomic factors to determine, okay, what is the value of this money after the time has passed. So with that being said, to calculate the net present value, you need to estimate those future cash flows for each period and determine the correct discount rate. Our answer here is going to be the internal rate of return. The internal rate of return is more for profitability, and the net present value is much more for should we accept or should we not accept. That is the big differentiating factor. Again, I wanted to talk a lot about them because, 1, they're important. 2, people get confused with them. And 3, they don't get talked about enough, to be honest. So wanted to discuss those. But really, at the end of the day, we were looking for a rate, and we're looking for our profitability. We're looking for a metric. This isn't really a metric. This is a should you accept or should you not. Not, oh, is it good? Is it better? Is it almost there to our rate that we're looking for? The final answer is internal rate of return. Next up, Yarrow Company is considered, well, we got a lot of information here, so I'm going to skip to the bottom and read the question first. That is what I like to do when we have a bulky question. I don't like to get intimidated here. What is the new machine's net present value? Well, as I mentioned before, let's write out a formula. We know net present value, nice and simple, equals inflows minus outflows. However, we do need to factor them. We need to discount them. We need to do time value money, present value factors. Generally, the outflow is going to be made in the first year. That one will be easy. And wouldn't you know it is easy. We're considering the purchase of a new machine that costs $450,000. That is to be assumed that it's going to get paid right away. It's not going to trick us too much. It's not going to say, oh, we pay this over the course of a few years. I mean, it could, but in that case, it would really just be a very hefty question. I will address questions like that where we need to factor both the inflows and the outflows. We're not going to get into that today. We'll just focus on the inflows. That's enough. Don't want to make you lose your mind today. So it's expected, unless otherwise stated, that we're paying $450 today in outflows. So that's that. I always like to write the formula out and populate what I can. It makes me feel good, right? Because we're closer to getting the answer. Net present value, this is what we want to find. Now, inflows. The new machine will generate net cash flow of $150 per year and net income of $100. Okay, right away, we need to determine, are we using net cash flow or are we using net income? That's something that's important to determine first. And we are going to use our net cash flow. So cross off net income. And why is that? Well, net income includes depreciation, taxes, a bunch of other stuff. Net cash inflow just literally says this is how much cash we're making. This is much more applicable for decision making. We're not going to take into account the taxes or depreciation or anything yet. So, and just this is a general rule. We're going to use net cash flow, not net income, for our project here. It's $150 per year. Now, if you didn't read forward and you didn't discount this or anything, you would say, okay, well, what do we got? We got $150 per year times how many years? Times 5 years. Well, that's like, it wouldn't be a wrong, like for the purpose of the test, for sure it'd be a wrong answer. But if I was looking at accepting a project and I just used $750,000 there, you wouldn't be wrong per se. That's one thing I want to get across. That's not necessarily a wrong answer in the real world. That just is a answer that's not taking into account time value of money and what you could have spent that money on in the meantime, right? Because you could have spent your money on something else instead of waiting for it to be collected, right? Like if I'm a small time investor, like if I'm buying, a small rental house to collect rental income, I'm probably not going to use discounted present value factors, right? It's not worth it to me. It doesn't really make too much of a difference. I mean, I could, and it might help me make a better decision, but the average person probably doesn't do this. This is for big companies, and this is the financial world. It's a good time. All right, so since we're not using $750, we are going to have to present value the $150. Now, we have present value of a 5-year annuity of $1 and present value factor of $1. Okay, well, which of these are we going to use? A couple ways to say this. If we have equal annual payments, right? Equal annual payments. This is something to memorize. Equal annual payments, we know, use the present value of annuity. Usually it's present value of ordinary annuity, but it can be annuity due. If it is present value of ordinary annuity or just annuity, that is assumed to be payments at the end of the year. If it's equal annual payments beginning of year, that is going to be present value of annuity due. The difference there, for one, just memorize it, but for two, if you make a payment at the beginning of a period, that's a whole extra year we have to account for, and that's why it's super important. Because at the end of the year, that's right, it's a whole extra year. It's a whole extra year of difference between these two. That's why it's definitely important to make note of that. In this case, and in a lot of cases, we won't see annuity due, but it's very fair. It's very likely you will see it, but in most cases, you won't see it. And then if it's a lump sum payment, we're going to use the present value of $1. So we see here the present value factor for annuity of $1, and we see present value of $1. We're going to cross off the lump sum one because we are getting equal annual payments of $150 over a 5-year period. And also, if the factor is ever less than 1, that's a lump sum payment. If it's more than one, it's going to be for multiple periods. So another thing to keep in mind there. We don't have to worry about the rate of return here. Some questions will have you worry about that, but obviously there's no other choice other than 6%. So no worries there. We're dissecting the question overall, doing well, crossing off what we don't need or don't need anymore. Okay, so our factoring, so instead of doing, right here, you can see this, instead of doing 150 times 5 equals 750, which is the simple calculation. Again, wrong for the purpose of the test, but not particularly wrong in real life. We're going to do 150 times 4.212 because this is what someone in an actuarial department, someone who is good at these calculations, determined this money would be worth over a 5-year period. It's about 0.8. It's worth about 0.8 less a factor, right? So that would be 150,000 times 4.212. That gets us to 631,800. And okay, we're still not done yet, right? That is, what did we just calculate? We calculated our inflows, 631,800. And what do I see initially? When we present value factored our inflows, it's still above our outflows. So right away, we're probably going to accept this project. I mean, I definitely would. Now, remember, this is just should you accept it. Like we saw in the question before, internal rate of return, that's going to be how profitable is it? 631,800 divided by, you could call that the profitability index. You could call this internal rate of return. I'll call it profitability index. You see it displayed like that sometimes. So again, maybe you have 3 projects that you should accept, but you can only accept one. So then you use the internal rate of return or profitability index to choose maybe the 1 or 2 most profitable based on their rates. But again, this is what we're solving for here. This gets us to a final answer of $181,800. I know I spent a lot of time on this, dissecting it. I think this is definitely time well spent. Lots of questions. Going to be talking about things like this. Time well spent practicing it here with you so you can tackle it well on your own on the exam. Practice this. We've got one more question for you here. Take one last look and we'll move on. All right. Lots of information, so I'm going to do my usual and read the answer, not the answer, the question. Which of the following is the company's cost of capital? Okay, that's immediately triggering a particular formula in my mind. And that formula, say it with me, is our weighted average cost of capital. We know that to be, say, after-tax cost of debt times weight plus cost of equity times weight. And then it would also be preferred stock, but do we have preferred stock here? I do not believe we have preferred stock. You won't always have preferred stock. It's going to be less common, but if we did, it would be cost of preferred stock times weight. Whenever you see your WACC formula, write this out. Like, even if you think you've got it down, do it for me, do it for yourself, write it out. You'd be surprised how much it'll save you points. It'll save you, anxiety. Just practice. It's good practice too, to write it out every time you are practicing. All right. Now, I like my classic plug and chug. Just pop in our numbers here. Well, do we have weights? Do we have costs? Okay, a survey of commercial lenders indicates that cost of debt is currently 8%. Now, I'm assuming that's after tax. And why am I assuming that? I don't see any mentioning of tax rates. So we just kind of have to assume it's after tax, right? There's nothing to indicate that it's the only thing we have to go off of. So that's 0.08 for the cost of debt. Company complies with this requirement and it has determined that a stock issuance would require a 10% return in order to attract investors. That is classic wordage for our cost of equity. We need to make at least 10% to attract investors. Investors invest in us. They give us capital. They give us equity. Awesome. We have our costs. Now, what are our weights? We have to figure that out a little bit. Now, we have a debt ratio of 40%. We see that, and I would immediately write out my debt ratio. Well, debt ratio equals total liabilities divided by total assets. For sure, definitely want you to memorize all these formulas. You see how The most random formulas could come into other questions where you might not think that they have a place, but oh, they do. All right, from here, do we have anything? Well, we have 40%. Okay, so 40%. And for here, we can actually make up numbers because we're trying to find weightings, and those are just percentages. So we don't need real numbers. But what would give us 40%? And again, I know, believe me, I know I don't see equity here. I see assets, but it'll all come together in a second. And actually, I'll just spoil it for you. We're going to be using our assets equals liabilities plus equity formula, our classic accounting equation. It's just right. We're gonna have that. So 40% total liabilities, total assets. What's a number pairing that would get us that? If we use our made up numbers here, what's a good example? Well, what equals 40%? $100,000 is a nice clean number. So $40,000 divided by $100,000 gives us 40%. Again, numbers don't matter because it's all about ratios. Now, if we say total assets is 100, we say total liabilities is 40. Well, ding, ding, ding. What is equity? It's got to be 60. Okay, great. Now, the weights here. This is debt. Our first one's debt. I'll put a D there for debt. I'll put an E there for equity. Okay, well, of the total, assets are irrelevant now. We don't need assets anymore. We have 40 of debt and 60 of equity. The total is 100. 40 divided by 100 gives us 40%. The weight of debt is 0.4 now. Equity, 60 divided by 100 is 0.6. Cool. Those are our weights. That's our market cap of our debt and equity. Simple formula here now. Definitely try to solve it on your own. You'd be surprised the small mistakes you make after just drilling through questions one after another. All right. I'll give you a second to figure it out. Final answer here. If you don't get it yet, feel free to pause the video. But I got good old 0.092, also known as 9.2%. Final answer is going to be letter A, 9.2%. Awesome. Lots of great questions. Yeah, I would say this is very much time well spent. These are nitty-gritty questions that lots of people have questions on. They always ask me about them. I'm glad to address these, and hopefully you can use these explanations and practice and not have issues with these in the future. That being said, thank you all for joining. We had a good old session on valuation methods and models, and I'll see you in the next one. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.